kick off our coverage this hour with two longtime market watchers. Sadiq Adatia is the Chief Investment Officer of BMO Global Asset Management, joining us here in studio. And joining us from the TSX, getting ready for the market open, Laura Lau. She's the CIO at Brompton Funds. Great to have both of you with us. Sadiq, I'll start with you. You're right here. Nice to see you. You heard my lead in there. What's your general assessment on where we go from here?
I think it's going to be a bit of a bumpy ride from here. I think you're right. We're going to end up the year in positive territory. But there's a lot to look at, right? A lot of data. The economy is weakening. There's no doubt about that. We are seeing job losses. But at the same time, what we are seeing is a strong consumer, savings that are still relatively high. And for the most part, companies are doing relatively well. And to me, that means that you want to remain relatively balanced in your portfolios. Don't take on excessive risk. Don't take off excessive risk. And doing that strategy this year has paid off. So I think you want to be cautious, but not being too overly cautious.
And Laura, how about you? What's your viewpoint right now?
I'm, pretty well on the same page with Sadiq. I do think it's going to be a bumpy ride. We're having this tug of war right now, worried about a recession coming, and then there's all this cash on the sidelines. So typically, this is the third year of a presidential cycle. It usually is the best year, especially after having such a horrible year last year. So I do think we're going to end up positive, and I do think you should have a balanced portfolio. You want to have exposure to stocks because they are the ones that are able to pass on price increases. They are able to cut costs. So I think that you do want some exposure there. But again, I wouldn't go all out full on risk.
Sadiq, what do you make of the fact, I was talking about the U.S. performance versus the Canadian performance. We do this all the time. We talk about how tech's had this big run. I mean, it's had a big run here in Canada too. It's just a smaller piece of the overall pie.
I think that's exactly it, right? It's the makeup of the composition of the indices, right? Canada's got high amount to financials and energy, both having a bit more of a difficult time. U.S. is benefiting off the tech boom, which is a bigger part of their index. I think you will eventually start seeing a bit of a catch-up at some point in time. I do think energy has a better leg up at the end of the year when China gets a little stronger in their economy. And I think that's one of the reasons why you haven't seen energy do as well, is though even though OPEC is cutting supply, what you're not getting is this strong enough demand. And I know you started off the session with that demand forecast, but that's many years out still, right?
A couple of decades.
Yeah, so I do think that's just a sign to say that they don't see anything imminently either, and why you're seeing energy pull back. And financials obviously has had the cloud, not only in Canada, but around the world, given what was going on in the U.S. I think that makes it a tougher time.
Well, I know
the stocks outperform.
The energy bulls have sort of been pounding their head against the table this year, but they still are sort of sticking to it being an interesting place over the next 5 years or so.
And I think that's the way to look at it. I don't think you can time the short-term movements here. I think you have to think about it from a longer-term perspective.
Laura, in terms of the Canadian market, let's say, versus the U.S. market, what's your view right now? I mentioned that, well, actually, it was you who mentioned that you're seeing companies take action right now. And between stock buybacks and dividends in the interim, has it created a compelling proposition for you, I guess?
I think it's becoming more and more attractive because we're certainly seeing dividends increase. We're seeing companies pay down their debt. But the macro environment is, if the economy is slowing, and Canada is more cyclical, especially, as you said, the high weight into energy, materials, and financials. So typically, in a risk-off environment, that's not really where you want to be. But at some point, the economy will pick up. And in terms of oil, I think I said this last time, Saudi Arabia knows a lot more than you and I, and they can see the physical market. They decide to cut production. So I think that they do see demand has been weak.
Okay, and Sadiq, bringing it back to you just in terms of, you talked about sort of being, I guess, diversified. Bonds are still an area that you're leaning into right now.
Yeah, we still like bonds over cash. I think you're going to start seeing at some point the yields, potentially even coming down. I think, we look for safety. Bonds should do well. If we do have a hard recession, which is not our base case, bonds should do exceptionally well in that period as well. So to me, you do want to have bonds over cash, but you still want to remain relatively neutral. And geographically, I don't think you want to take too many bets either way. I think quality is where you want to focus on, and that's whether it's Canada, U.S., internationally, or even in emerging markets. But I do think when you think about the consumer, you have to think about the consumer will eventually start to slow down, and you will start to look at opportunities of where that money will go to, because it won't go into the typical places it would when the economy is strong. It'll start going to more of the staples, and I think the staples are an area you want to be in later on in the year as you get closer and closer to that recession, which we don't see happening until 2024.
2024. So you said, so your base case is what for?
So for this year, we expect the economy to continue to still chug along and do quite well. Consumer to hold up, but showing some signs of weakness. You'll see job losses in one sector or two, and then what you'll see is other sectors still looking for jobs to be hired. And so the movement will go away from higher paying jobs to lower paying jobs, but still having jobs. So you won't go from spending a lot, spending nothing, but going from spending a lot, spending a little less. And that should keep the economy still chugging along. And as you said, the recession part won't be until a later part in 2023 or early part of 2024. And even that has a risk to get further pushed out as well, like we've seen so far this year.
Laura, why is it that we keep pushing out this recessionary risk? We've been talking about it, I feel like, for 2 years now.
I think that this is a recession we've never seen before. So it's called a rolling recession or rolling recovery. And part of the reason why is the economy is out of sync. In the old days, when you had a recession, nobody would buy cars, no one would buy houses, they'd be just scared. This time around, people have jobs, you can't get a car. We're seeing a manufacturing recession because people bought all their stuff during COVID, but they're dying to get out and live their lives. So we're seeing services very strong. So what we're seeing is weakness in the goods sector be offset by strength in the service sector, such as travel and such. So as a result, we think this time the recession will not be as deep as before. And if you have a job, you keep on spending, you keep on paying your mortgage.
Yeah, and actually that kind of gets us to the final view on interest rates. Maybe I mentioned we're going to get some inflation data tomorrow. Laura, I'll come back to you for a final word. Do you anticipate the Bank of Canada raising interest rates again next month?
I do think they will, and despite what this CPI number, the inflation number, comes out this week, because typically when the Bank of Canada increases interest rates, it's not just in isolation, and they had fallen behind the United States, so they're just catching up. So we do believe that the Canadian economy is stronger than anybody had expected, and they'll likely increase interest rates.
Sadiq, variable rate mortgage holders on the ropes right now. Are you anticipating another rate hike?
I do as well, too. I think the Bank of Canada took a pause at the right time, actually, and now they let the information come in to decide to continue on with that. The Fed will probably do a similar thing as well. Well, they will sit on the sidelines to watch a few more economic data points before they decide to pull the trigger.
Okay.